So frequently, we're taught or we think of prices as indicative of value, right? But they're really not. Value is subjective. So prices don't really measure. But what they are is, it's good to think of prices as exchange ratios derived on markets, right? And those are established by the entirety of individuals, everybody buying and selling, right? So more people decide to buy something, the price gets pushed up a little bit, that sort of thing. So prices are always fluctuating somewhat, even without inflation, again, relative prices, and sometimes they fluctuate a lot. And that's really part of the genius of the price system, is that as prices rise, they indicate scarcity. And that directs, spontaneously, without any sort of command directive or anything like that, rising prices sort of signal to the world of producers, hey, there's a shortage here. And what that means is, if you're used to sell here and now the price is up here, that means there are profit margins. There are increased profits for bringing more goods to this particular area, whether that's lumber, whether that's other finished goods, whatever. So prices rise, they signal scarcity. They serve to direct resources towards certain uses, whereas when they fall, they indicate abundance. And people would say, well, maybe instead of, bringing this good to the market, I'll bring another. And that's the way the price system works. It's an absolutely brilliant system.
Yeah.
The market's a process, right? We like to think of it as a fixed establishment. And of course, because we have supermarkets and stock exchanges, we think of markets as places. But the market is a process. And it's actuated by the interplay of the actions of various individuals that cooperate under the division of labor, right? So forces determining this continually shifting state of the market are subjective value judgments by individuals and their actions, right? So they buy things, they sell things, and at any given moment, the state of the market is, at that instant, that price structure is basically the totality of the exchange ratios of goods established by people, right? Yeah. So what that means is that when entrepreneurs look at prices to determine real scarcity, they engage in a process called economic calculation. And that economic calculation, although it's called calculation, it really is sort of a qualitative assessment. They say, I'm looking into the market, here's a good or a service that I think consumers want, but it's not available. And then this calculative process means they say, if I take good A plus good B, I can do it for a certain price, and maybe I can offer it for a profit. And that's how consumer desires are met by entrepreneurs. So this ranges from everything from capital goods created by investing, whether that's machines, buildings, and all that, to the very end goods in the term structure of production, like toothpaste, things you and I would buy. That whole process of production is a product of economic calculation at different levels, right?
Yeah.
So there's a reason why we use concrete and not copper to build bridges, right? Because we have figured out with prices where the best uses of our time and of those resources are. It's rational economic allocation. And so when monetary expansion causes price inflation, we'll just call it inflation, the information content of prices is reduced. So, you can think of it, if you're familiar with the concept, as a higher noise to signal ratio. And it's much more difficult for entrepreneurs to figure out what the best use of resources is.
Right.
And in turn, we'll talk about this with the next thing I'm going to mention. And in turn, it's very difficult to determine whether a given project is going to be profitable or not. All startups are speculative.
Yeah.
Right? But with the monetary unit fluctuating beyond, the expected day-to-day shifts, resources are more likely to be misallocated. And what happens is, with less effective uses of resources, we have less productivity altogether. And productivity is where growth and prosperity comes from. So this is what. By the way, I think an important thing to mention here is that this was the inability to calculate economically. It was basically Ludwig von Mises' one-stop defenestration of the possibility of socialism. Without prices, rational allocation is impossible. Now, we're not talking about no prices, but we're talking about prices which are increasingly distorted by monetary policy. So that's the inability to calculate economically, or less efficient economic calculation, is another result of expansionary monetary policy and price inflation.